Let's just take a moment and take this picture in as we think about the impact of rising interest rates and what they're likely to do. So I like the metaphor of the dumpster fire. It's pretty simplistic if you think about it. You need a container, you need a bunch of junk, and you need a precipitating event, something that's going to start it. In this case, what's starting it is something that's actually very good, in that we have a new administration coming in. An administration that is going to approach the problems we face as a nation and a world with, I would say, a degree of competency we haven't seen in quite some time. A part and parcel of that is going to be getting our economy up and running in a real way. First, we've got to dig ourselves out of the hole that we're in. So rule number one is stop digging when you're in a hole, which the prior administration never quite seemed to figure out. And rule number two is money is relatively cheap right now, so go borrow a bunch of it and do some cool things with it. Create a multi-trillion-dollar infrastructure project that you finance by giving people who invest in those bonds tax-free income. Stimulate the economy with new jobs that may become available around things that this country has needed for an extraordinarily long time. And primarily, have people that know what they're doing go out and do it. Interest rates have been sitting in a negative yield curve for an extended period of time, not because the country was in good shape, not because the Fed liked negative interest rates or really low interest rates. We have been in this fugue nightmare of who the hell knows what's going to happen. It got to the point where I was literally afraid to open my email in the morning for fear of what I would see. Well, we're not out of the woods yet, and there's some ways to go, but we know certain things are going to happen. We know the yield curve is going to normalize. That started probably a couple weeks ago, but the action today on the 9th of November, 2020, where we have a new president coming in, confirms that economic activity will be on the rise. Keep in mind, those of you newer in the business, the stock market basically discounts everything that it possibly knows and tries to price everything fairly based on every piece of information that's known, and does a fairly shitty job. The bond market, on the other hand, tells you what's going to happen going forward. You want to know where the economy's going? Don't look at the stock market. Look at the bond market. And not short rates that the Feds control, but the long-term interest rates that's controlled by the market. As they say, bond market has predicted 14 out of the last 7 recessions, but I'd rather bet my money there than any place else. Now, bonds as an investment obviously have been problematic. But for some people, they've been much more than that. And at the moment, they are, as you can see on this GIF I have here, in the process of turning into a dumpster fire. So let's just review, for those of you that missed my post 5 months ago where I said, hey, this is going to happen. It's happening. In fact, not only is it happening, but it's happening and it's beginning to reverse. We had a ton of money come in, all at the wrong time. End of 2019, early 2020, tons of money went for the safety trade. Risk off, bonds on, government bonds, that's where we got to be. We don't want to open an account for $100 at Treasury Direct. I mean, that's too much work. Let's go to Fidelity and pay them 45 basis points to buy us a yield of 1.5%. They're going to keep an eye on the government, make sure it pays. I mean, just think about that. It's ridiculous. Why do people buy these things? It doesn't make any sense. By the way, the bond fund managers who run these, they probably hate themselves. They must, because they can't do anything different other than meet redemptions when orders come in, which they're beginning to, or put the money to work when it does come in, as it did in the earlier part of this year. So what we're seeing right now is probably a reversal. If I were to update these charts, which I probably will do over the next few weeks, you're going to see the fact that you've got net liquidations in these funds. And I'm just going to speculate and say that these bond fund managers don't want to show losses, so they're going to be taking capital gains. Get the profits while they're there. Great. Now you get to pay some taxes on what should have been interest income. Not a great thing, but these guys want to get out, and they're going to sell, by the way, the bonds at a profit, which are, of course, the ones with the higher coupons. This trend is going to reverse. People aren't putting any more money in these things. NAV is going to come off. Your yield's already fallen through the floor. Now you get the second side of that coin, which is to watch your NAV go down. Why did it happen? Pretty simple. Look where the coupon distributions were 10 to 12 years ago. You had a whole bunch of coupons north of 4%. There's, 38 from there, 52, 56% of your coupons were above 4% back in '09. Well, where are they now? Now you've got 48, 60% of your coupons are below 4%. Average government bond fund, as I speak, average coupon is somewhere between 1.7 and maybe 1.5%. So think about it. If you owned a 20 or 30-year government bond right now, that's essentially what you got. What's going to happen? You're going to get hammered. That's what's going to happen. Why? Because that's what always happens. Take a look at this Dow bar chart. You guys have probably all seen this thing about how equity investors, without guidance, without advice from professionals like you, are always doing the wrong thing. In fact, I used to look at cash flows into equity funds as my number one contraindicator. When the public was blowing it off to the upside, they couldn't put enough money in stocks, I was looking for the door. And when the public was liquidating like you couldn't believe, I was putting money in. Why? Because the public is always wrong. Because if everybody's doing the same thing, there's either nobody left to buy or nobody left to sell. But in bond funds, it's different. Equity funds don't suffer the same type of dilutive effects. So the public can be the public and only get a 388 return versus 562. Because of the way cash flow works in bonds, however, take a look at the Barclays Ag, 455 unmanaged index. But the public during the same period of time in open-ended mutual funds, 0.22. Shouldn't the numbers correlate more to what we saw up in here? They don't. Why? Because all the money goes in at the wrong time. It also comes out at the wrong time. So what do we end up with? We end up with this. And this is not something we're really wild about. There's our Fidelity Government Income Fund we put to work on 1/3/2011. We had good intent. Everything looked good. Might as well let Fidelity buy the bonds. It's a good name. They'll take care of it. It's got a nice, safe-sounding cadence to it. Fidelity Government Income Fund. Ooh, we provide investors exposure to government and government-related sectors of the U.S. bond market. Government-related sectors. What, like cousins? Brothers? What? No. Ginnie Mae's. Awesome. They buy mortgages. What a great investment to hold as interest rates are crashing and people are refinancing their mortgages and paying them off early. So you get back cash that they have to go reinvest. No wonder there's a 245% turnover. Not to worry about those managers. They're getting 45 basis points for all this great work. I wonder if they bought those things at a premium. My guess is they did. I guess we'll find out when we see their annual reports, but I am seeing capital gains come out. So some of the income that your clients should have gotten and aren't getting, some of that income is going to be characterized as capital gains. What a great bunch of guys. Put $100,000 to work back in 2011. Here's where you are. You're at 1093. Now this was about 1140 several weeks ago. Total income 24,191 to the penny. 245 average current yield, not bad for 10 years. Kidding. 104,895 your value if you get out now. That's the best news here. Why? Because you can actually get out and still preserve the client's initial investment. Total return 29,086.21, 2.95%. Could be worse. And it will be worse if you just sit there and nod your head and say, yeah, this guy's full of shit. I'm not going to pay any attention. Good. Don't listen. And then come back in 6 months and go, what do I do? I should have listened. Oh, my God. My clients are all so mad at me. Yeah, they are. You know why? Because you're an idiot. Because you didn't spend the time to understand how structurally unsound these frickin' investments are. Of course, you could have bought a treasury bond. Maybe you wouldn't have got that big payday you got from buying them a B share or an A share in a goddamn mutual fund. So you bought them a bond. Ouch. Really hurt. You got paid a little bit less. But look what happened with your client. You bought him a real bond that had a permanent cash flow and a definitive interest rate. You could actually tell them, here's how much you're going to get, and here's when you're going to get it. So what did this thing do? Well, I bought it at par for this client. Now it's 151. What's my income? 43,126 again to the penny. 438 or 4.375 current yield. Total value right now, if I were to sell the bond, 151,420. Looks a little better than that. 94,546 total return, 959, 9.59% versus 2.95. If you want to do a really frustrating exercise, and I didn't do it here for the sake of time and not pissing you off completely, is basically take about a 6.5% return and put it up against $100,000 and compound it out over the period of time you sat in the frickin' bond fund and didn't make the money. And you're going to look at it and go, ooh, that kind of sucked. Yeah, it did. It truly did. What you don't want to have happen is for your clients to actually have to sit any longer than they did. Here's some estimates of what's going to happen to open-ended bond funds as rates normalize. Rates go to 2.5% 6 months from now, you're going to be down about 11 grand. They go to 3% about a year from now, you're going to be down 18 grand. And they go to 3.5% a year from now, you're down 24 grand. Now, we've been living in this netherworld of just incredibly low interest rates, thinking, oh, rates are low, bonds suck, we shouldn't do that, let's just let Fidelity manage it. Well, that's not the way it works, because we're going to get back as economic activity begins to pick up, as financing is done by competent people to invest in real things like infrastructure, like clean energy, like jobs that people can actually get and make a living wage, like a higher minimum wage. What's going to happen? Here's what's going to happen. Two things. Rates are going to normalize. Yield curve at the bottom is where we are as of right now. And you can see that yield curve is now taking on a positive slope. That's a good thing. It means there's economic activity out there. Now, you can see a year ago, the thing was starting to collapse. That's the middle part of the yield curve. And you can see 2 years ago, back in 2018, wasn't looking so healthy then, but look where long 30-year rates were, 3.5%. Here's what happens to your bond funds when you get to the 3 and 3.5% positive yield curve. You have a problem that is predictable and it's avoidable, and this is what you're going to get. So, what do? Sitting still is not the answer. If your clients don't own them, talk to them about what they're holding in their 401k, and talk to them about friends they know that may actually be holding these things. Because the 3 questions you have to ask before you ever recommend a fixed income investment is this. When does the investment mature? Go look at every single investment on your book. Ask that in fixed income. Ask that question. And if you don't have something that comes up with numbers, you don't have a fixed income investment. You got something else. Maybe it's good, maybe it's bad, but it's not fixed income, and for you to carry it in the fixed income category is wrong. Wake up. How much do I get back when it matures? It's a simple question. Face value of the bond. I pay $120 for a par value bond. I got 20 points going away. When I get it back, I know that. But I've got enough income coming in the meantime that put together, I've got a decent yield. How much do I get paid between the time I buy it and the time it matures? As a fixed income investor, I think that's a pretty good question. Or as a whatever income investor, mystery income investor, I buy a bond fund and I have no idea what's going to happen. You can't plan for them. They don't come due. They are, in my opinion, a scam. Why are they out there? Black t-shirts. What do you mean? Well, most t-shirts aren't black. I'm wearing a blue one. But if you want a black t-shirt, and that's the only thing the client's going to buy, you sell them a black t-shirt. Why are bond funds out there? Because they're easy. The story sounds okay, and people hear the name and they say fine, and they don't get how individual bonds work. I think it's bullshit. And I think if you're their advisor and you're taking the easy way out, shame on you. Get them the F out. You got time. Talk to them. If they work for a company or they've got a 401k, they have these things. Find out where their friends are. Go on a quest to make certain everybody you know and everybody that who you know, they know, don't own these things. Because 6 months to a year from now, if you replay this or I cut another one, I'm going to say, what did you do when the world woke up? When the economy started to go back to something we recognized and rates went back up? You can bring a lot of money in pointing out to prospects what's about to happen. Or you can stay there and sit on your ass and watch. You want to know why I built a $450 million book? This is one of the reasons. If you like what you hear, hit the like button. If you like it a lot, send me a thing and let me know. You can't stand what you're hearing, feel free to flame me on the comments. Either way, appreciate your time. Best of luck and strap in. It's going to get interesting.